Welcome to The Explainer. Today, we're diving into a real financial mystery that has a ton of people in the crypto world scratching their heads. You see, XRP got some major good news, but its price immediately dropped. So, let's figure out why.
Okay, so on one hand, you've got this huge new investment product for XRP launching on the New York Stock Exchange. I mean, this is the kind of thing that should have sent its value absolutely soaring, right? But what actually happened was the complete opposite. The price just tumbled.
So what is really going on here? Let's dig in, unpack the clues behind this super confusing market reaction, and uncover the powerful forces that are battling it out just beneath the surface.
All right, our investigation kicks off with the one event that was supposed to be a massive game changer for XRP. This is really at the heart of the whole paradox.
So, Grayscale, who's a huge name in crypto investment, officially launched its XRP spot ETF. And you've got to understand, this is a really big deal. Why? Because it gives everyone, from giant institutions to regular investors like you and me, a super simple, regulated way to get exposure to XRP.
Now, the key phrase here is spot ETF. This is absolutely critical. It means that for every single dollar that goes into this fund, the fund manager has to go out and buy actual XRP tokens. They're literally taking them off the open market, which, you'd think, would shrink the supply and drive the price up.
But here's that paradox in plain sight. Instead of a big rally from all this new demand, the price did the exact opposite. It dropped from $2.13 down to $2.08, crashing right through some really important psychological support levels.
You see, this great news didn't just happen in a vacuum. To really get why the price dropped, we have to look at the other forces, the immediate pressures that kind of overshadowed this huge announcement.
Well, the most obvious answer points to a classic case of what traders call selling the news. You know the drill. People buy up an asset hoping for a big announcement, and the second it goes public, they sell to lock in their profits. That, combined with just generally weak market momentum, created the first big wave of selling pressure.
And this shows you the technical damage that was done. Think of the $2.10 level as a safety net, a floor for the price. Well, once that floor broke, it instantly flipped and became a ceiling, making any kind of price recovery a whole lot tougher.
But that's not the whole story. There's a deeper clue to this mystery, and it involves the biggest player in the entire crypto game, Bitcoin.
Yeah, this headline kinda gives the game away. It reveals this hidden connection. The weakness in XRP wasn't just about XRP. Nope. It was directly tied to what was happening with Bitcoin.
This whole process is called capital rotation. Here's how it works. Traders make a bunch of money from a big Bitcoin rally. So they sell their Bitcoin to lock in those juicy profits. Then they take that cash and use it to sell other assets, like XRP, which pushes its price down. So, kind of ironically, Bitcoin's big success actually created a major headwind for XRP in the short term.
Okay, now let's get to the real plot twist here, because this isn't just about everyday traders. Oh no. Beneath the surface, there's this invisible war being fought between two different groups of financial giants.
So picture a giant tug-of-war. Pulling on one side of the rope, you have massive, relentless buying from institutions. We're talking U.S. spot XRP ETFs, seeing over $170 million in new money every week, with absolutely zero outflows. This is steady, long-term buying. And the effect of all this buying is just staggering. It's causing the available supply of XRP on exchanges to shrink dramatically. Get this, in just the last 60 days, 1.35 billion tokens have been pulled off the market, probably into safekeeping for these new ETFs.
But pulling just as hard on the other side of that rope are other big institutions. At one very specific price point, the selling volume just exploded, surging by 205% over the daily average. Now, this isn't panicked retail investors selling off. This is strategic, targeted selling by the big guys.
And guess where this epic battle is taking place? You got it, right back at that $2.10 price level. The massive institutional selling is completely focused on defending that exact price, creating this fierce battleground that the market just can't seem to punch through.
So what happens when you have this massive, unstoppable buying force crashing into a seemingly immovable selling force?
Well, you get a market that's being squeezed from both sides. The constant ETF buying is creating a solid floor under the price, while all that institutional selling is creating a hard ceiling above it. And what do analysts call this? A coiled spring. The pressure is just building and building as the available supply gets tighter and tighter.
And there you have it. The mystery is solved. The immediate short-term story looks pretty bearish, right? It's all about profit-taking and that massive wall of selling at 210. But the underlying long-term story, that's becoming incredibly bullish, as these institutions are quietly scooping up more and more of an asset that's getting harder to find.
So the big takeaway here is that this quiet, powerful tug of war, it can't last forever. The pressure is building. And that leaves us with one final, very provocative question for the future. With the supply shrinking and these giants at war, what happens when one side finally gives way?